And finally tonight, we've been profiling all week some of the people who were the difference makers in the world of business and finance. It's safe to say no individual had more influence on the stock and bond markets than Ben Bernanke. And the Federal Reserve Chairman kept market mavens guessing all year on when he would begin tapering the bond buying, which helped fuel the bull market. Here's Steve Leisman with more on Ben Bernanke.
For most of the second half of 2013, Fed Chairman Ben Bernanke sang a single tune, "Don't fear the taper." But it wasn't always well received on Wall Street. He first warned in May of a possible reduction to the Fed's bond buying program known as quantitative easing, or QE.
If we see continued improvement and we have confidence that that is going to be sustained, then we could, in the next few meetings, we could take a step down in our pace of purchases.
The Dow Jones Industrial Average would lose 90 points over the next 2 days and 400 points over the next week. In June, Bernanke spelled out a schedule for ending QE.
We would continue to reduce the pace of purchases in measured steps through the first half of next year, ending purchases around mid-year.
The Dow would shed another 500 points over just 2 days. But after a weak August jobs report and the government on the verge of a shutdown, Bernanke would reverse course.
The committee concluded that the economic data do not yet provide sufficient confirmation of its baseline outlook to warrant such a reduction.
The Dow, up 20% on the year, would rise a percentage point on the day. And then in December, after working all summer and fall to convince markets that tapering wasn't a tightening of interest rates, Bernanke took to the podium for his last press conference as Fed chairman.
Starting in January, we will be purchasing $75 billion of securities a month, reducing purchases of treasuries and mortgage-backed securities by $5 billion each.
The result? The market surged 300 points, and Bernanke finally got his taper in a way that did not spook markets. Over the year, Bernanke and the Federal Open Market Committee ballooned the Fed's balance sheet by more than $1 trillion and helped push up growth from 2% in 2012 to an estimated 2.5% this year. The 10-year benchmark Treasury bond would rise by more than a percentage point. Unemployment would decline by 0.8% to 7%, and inflation would remain quiet. What's clear is that Bernanke's decisions made a huge difference this year and will for many years to come, as the effects of current policy play out, perhaps through higher growth and lower unemployment, or perhaps also, as some fear, through inflation and a more difficult exit strategy being left to his successor, Janet Yellen. For Nightly Business Report, I'm Steve Leisman.